Most people believe the future of their money depends on how hard they work, how smart they invest, or how disciplined they are with spending. That belief is already outdated. Because quietly, without a single public vote, a new decision maker has entered the financial system. It doesn't sleep, it doesn't forget, it doesn't feel sympathy, and it doesn't care whether you think a decision is fair. Artificial intelligence is no longer just predicting what you might buy. It is deciding what you are allowed to buy, what you are allowed to borrow, how much risk you are permitted to take, and increasingly, whether you deserve access to money at all. The unsettling truth is this: the future of your wallet may no longer be decided by markets, governments, or banks alone. It is being shaped by algorithms trained on data you never consented to give, operating under rules you will never see. It's the most dangerous part. Most people won't realize what happened until the decision has already been made. But to understand how we arrived here and where this path leads, we need to go back. Not to the rise of AI, but to the moment money itself began surrendering judgment to machines. For most of history, money decisions were deeply human. A banker knew your family. A lender assessed your character. Creditworthiness was imperfect, biased, and often unjust, but it was personal. That began to change in the mid-20th century. As economies scaled and populations exploded, human judgment became inefficient. Banks needed speed. Governments needed standardization. Corporations needed predictability. So they turned to models. In the 1950s and 60s, credit scoring systems emerged not to replace people, but to assist them. Early algorithms were simple: income, debt, payment history, a few variables, a few thresholds. But something subtle happened. Once decisions became measurable, they became optimizable. Once they became optimizable, they became automatable. And once they became automatable, humans slowly stepped aside. By the time the FICO score became dominant, millions of financial decisions were already being made without human context. The system didn't ask why you missed a payment. It only recorded that you did. Efficiency improved. Profits rose. Risk appeared manageable. And that success planted the seed for something far larger. Because if algorithms could decide who deserved credit, what else could they decide? The rise of AI in finance didn't begin with robots or neural networks. It began with something far more mundane: data. Every transaction you make, every bill you pay late, every subscription you cancel, every store you walk past without buying these events, leave digital traces. By the early 2000s, financial institutions were sitting on oceans of behavioral data. And unlike humans, machines could analyze it all. Machine learning entered finance quietly. First in fraud detection, then in risk modeling, then in pricing. Banks discovered that AI could detect patterns no human ever could predict default before a borrower missed a payment. It could estimate spending behavior before income changed, could flag financial stress before a crisis occurred. From the institution's perspective, this was a breakthrough. From the individual's perspective, something else was happening. Judgment was no longer reactive, it became anticipatory. You were no longer evaluated based on what you did. You were evaluated based on what the system believed you might do. This is where the power shift occurred. AI systems began adjusting credit limits automatically, raising interest rates silently, declining loans without explanation, flagging accounts for enhanced monitoring, and they did so with no human intervention. No banker looked you in the eye and said no. No appeals desk reviewed your circumstances. The decision arrived fully formed, delivered as fact. This wasn't science fiction, it was operational efficiency, and it was only the beginning. The true transformation happened when AI stopped merely predicting financial behavior and began shaping it. Consider this: if a system believes you are likely to overspend, it can raise your interest rates. Higher rates increase stress. Stress increases default probability. Prediction becomes self-fulfilling. If an algorithm decides your neighborhood carries higher risk, your insurance premiums rise. That leaves less disposable income. That worsens your financial profile. The model was right because it made itself right. This is not bias in the human sense. It is structural inevitability. AI systems optimize for outcomes defined by institutions: reduce losses, stabilize liquidity, predictable behavior. They are not designed to care about fairness. They are designed to reduce volatility. And volatility, from the system's perspective, is you. By the late 2010s, this logic extended far beyond credit. Investment platforms began using AI to nudge retail investors toward appropriate risk levels. Spending apps encouraged certain behaviors while discouraging others. Insurance pricing became hyper-personalized. Loan approvals became opaque. Financial autonomy quietly narrowed. Then came central banks. Central banks watched this evolution carefully. They understood something crucial. AI didn't just manage risk, it enforced discipline. In a world drowning in debt, discipline was no longer optional. As global debt ballooned and traditional monetary tools lost effectiveness, policymakers faced a dilemma. Interest rates could only do so much. Inflation targeting was blunt. Fiscal policy was politically constrained. But AI offered something new: granular control. Instead of raising rates for everyone, systems could target behaviors. Instead of broad tightening, they could restrict specific categories of spending. Instead of trusting markets, they could manage flows directly. This is where digital currencies enter the picture. Central bank digital currencies are often framed as convenience tools: faster payments, lower costs, financial inclusion. But embedded within them is something unprecedented: programmable money. Money that can expire, money that can be restricted, money that can be conditioned on behavior. And AI is the only entity capable of managing such complexity at scale. Imagine a system where your spending limits adjust dynamically based on perceived financial health, where access to credit depends on compliance with economic priorities, where risk tolerance is assigned, not chosen. This is not speculative theory. Pilot programs already exist, and the justification is always the same: stability. At this point, many assume regulation will step in. The transparency laws will force explanations. Human oversight will restore balance. History suggests otherwise. Regulators move slowly. Technology moves exponentially. Even when rules exist, enforcement struggles to understand systems that learn and evolve beyond their creator's original design. Explainability is promised, but rarely delivered in meaningful form. A reason code replaces understanding. Checkbox replaces accountability. And the institutions deploying AI face no incentive to slow down. The systems work for them. Efficiency improves. Losses decline. Control strengthens. So reforms circle the edges without addressing the core issue. Decision-making authority has shifted away from humans. It will not be voluntarily returned. This is not the first time technology reshaped money and concentrated power. When double-entry bookkeeping emerged, merchants gained dominance over monarchs. When central banking matured, states gained power over markets. When digital finance arrived, institutions gained leverage over individuals. Each transition was sold as progress. Each reduced friction. Each narrowed autonomy. The difference now is speed and invisibility. Previous shifts were visible. You could see a factory. You could see a bank. You could protest a law. You could not see an algorithm deciding your financial future. And because its decisions arrive dressed as neutral outcomes, they are rarely questioned. But the data reveals the trajectory. Financial exclusion is rising despite increased access. Household debt decisions are increasingly automated. Appeals processes are shrinking. Behavioral scoring is expanding. The system is becoming more predictive and less forgiving. The future of your wallet will not hinge solely on income or effort. It will depend on how you are categorized. It's not who you are, but how you are modeled. Your spending patterns, your social environment, your digital behavior, your compliance with invisible norms. Once those models solidify, escaping them becomes difficult. Because algorithms don't forget. They don't reset. They don't offer second chances easily. This doesn't mean collapse is inevitable. It means transformation is underway. Like every transformation before it, the benefits will flow upward unless actively resisted. Here are the 3 takeaways. First, AI does not remove human bias. It encodes institutional priorities. When profit and stability define success, individual outcomes become secondary. Second, financial control is shifting from rules to systems. You may follow every law and still find yourself restricted by a model you never see. Third, autonomy in the future will belong to those who understand the system early, not to those who trust it blindly. The question is no longer whether AI will influence your finances. It already does. The real question is whether you will remain a passive data point or an informed participant in a system quietly reshaping power. Because once money becomes fully automated, the most dangerous thing you can be is unaware. And if this perspective challenged the way you see finance, history, and power, leave a comment. Share your thoughts. Subscribe to the Fiscal Archivist, because understanding the system is the first step to surviving it.